Hi, and welcome to this episode of Financial Planning Innovation. I'm your host, Marc Glickman. I'm an actuary by trade, and I have the pleasure of speaking to Gary Weiss today. Thanks, Gary, for joining us.
My pleasure, Mark. Glad to be here.
So, Gary's a comprehensive financial planner. How did you get into that space?
My father was an advisor for 39 years, all with E.F. Hutton slash Shearson slash Smith Barney. And after graduating University of Arizona in 1990, I spent a couple of years in Southern California in outside sales and realized that I enjoyed that process and enjoyed having no cap on my income and helping people solve problems. I wanted to do something that was more intimate and more beneficial everybody would need. And I thought about financial services and decided to come back to Arizona and applied with Shearson as a trainee in September of 1992.
Wow. Okay. So you've been in this for nearly 30 years. Has the marketplace changed a lot in terms of the types of process and approaches you use with clients?
Absolutely. I used to cold call with tax-free bonds. And if I would, open an account, it was usually on a single stock. Where today we are primarily all managed money and do very comprehensive financial planning on a much bigger scale.
Right. So it used to be more of a transactional approach and people would buy products, so to speak, from you. And today it's much more about holistic planning. And I think that's a good topic for today. Tell us a little bit about your holistic process that you use with new prospects or new clients that work with you.
Sure. We use a proprietary software product called Goal Planning and Monitoring, GPM for short. And what it does is it measures the likelihood of us meeting our financial goals, setting certain financial goals as comprehensive as we want: retirement, education funding for kids, travel, new vehicles every 10 years, whatever we want, weddings, whatever you want to throw in there, charity. And it basically gives us a predictability measure of what's the likelihood we're going to be able to achieve those goals without running out of money. And it's the foundation of all of our relationships. It's what we use as our primary measuring stick to how we're doing.
Okay, and it kind of starts off with a consultative approach, like a fact finder, essentially, right, that you're working with clients on?
Very much so. We do that in our initial meetings. Is like when you're going to a doctor giving a comprehensive medical history before they diagnose you. We want to know, the full gamut of anything financial that goes into the plan.
Okay. Well, why don't we take as an example? I know you'd mentioned that you had a prospect that came to you, and what stood out about this situation and this prospect?
Well, what it does is it makes people. It just brings awareness. So some people have it, and some people really need it. We were introduced to this very nice couple, and we met with them, went through our process, and they were taking out quite a bit of money relative to what they had. It worked out to be about 7% on a withdrawal rate. They didn't have any idea about that. They just knew they were taking out X amount of dollars a year. And, we really, we sort of gave them an eye-opening conversation, about you potentially could have a big problem here in the future. And their current advisors weren't telling them anything like that. They were just sort of going along, riding a hot market. But they're on a crash course. It's a matter of how far out it is and what adjustments can be made before it happens.
Right. And were this couple was already retired, or were they still employed and earning income?
They're retired and have no interest in rejoining the workforce. So they need to do what we call behavior modification, or
right.
Start selling some assets that you're enjoying very much that are not financially producing income.
Right.
If they have a nice summer home up in the mountains, that's great, but you might want to take that money and put it in something income producing and, rent a place for a few weeks a year when you want to go.
Right. I would say like 20 or 30 years ago, the rule of thumb used to be a 4% withdrawal rate. And because of today's low interest rates, I'm sure that's down, at 2, 3%. So they're way off the mark in terms of what's going to be financially solvent for them at the end of the day, right?
And what this process does is spell it out for you very clearly about what you have, what you're living off of, all your sources of income, Social Security, pension,
Hmm.
required minimum distributions, what have you, and show you what your portfolio value is, in both a linear, simple market environment or stress test market environment, which we always do.
Hmm.
We the time for a map is before you're lost,
Right.
not when you're in the middle of the jungle.
Right. And this is why it's so important also to work with a financial professional and an expert in this area. Obviously, they have the software programs like you do. They can kind of construct this, portfolio approach where you're predicting, at least looking at what are the likelihoods that they'll have success in their plan in 20 or 30 years. And what do you guys kind of target in terms of, people that you run into, and what likelihood of success that they should have when you're doing this approach?
Oh, it's funny. The confidence range is 70 to 90%. We always say those aren't really the odds you want from your surgeon, but for what we do, it works pretty good.
Yeah.
We say these get degrees in what we do. So getting, if you're in the 70s, you're looking pretty good. For those who are in the 90s, we constantly are encouraging them to live it up a little bit, or start gifting aggressively, or increase your philanthropy. Anything you could do where you're not going to leave your kids so much money that they can do nothing. Most of our clients aren't interested in that.
Right. And I would say everyone has a different risk tolerance, right? They have, a different philosophy around, how they want to spend and how they want to save and that type of thing. So you're incorporating all those dynamics into your plan because it's really their decision at the end of the day as to what they want to do. You're just guiding them to that answer.
Absolutely. One of our favorite slides on the deck is the what we call our risk slider, and it basically asks from 0 to 100, how aggressive or conservative do you think you are? And it's amazing what people think. When the S&P's up 28%, they want to be up 28%. But when we show them what happens if you have that kind of exposure during 2007 to 2009, they're like, well, I don't really want to go through that again. And so, well, that's why we live over here on the conservative side of the street, and we have, a more modest or more balanced approach. And then they usually say, oh, yeah, I like those numbers way better.
Right. And I would say it's hard to believe it's been 10 years, plus since the financial crisis, but people just forget, right, about that.
It's crazy. I mean, people tout 10-year track records, and then they're straight up. They don't include any bad times more than a couple months.
Right, exactly. And I would say this happens in the insurance world too, where I work in long-term care insurance, where you don't always have to get 100% certainty. You don't have to build a 100% plan. Do what's right for you. You can get part of the way there, right? And supplement that with other planning techniques. But it's a very customized approach, and I'm glad that you offer it to your clients.
Absolutely. We're big on if you can't solve all of the problem, at least solve part of the problem. Let's address it and not ignore it. Don't be an ostrich with your head stuck in the sand and just ignore it. Face the day, and let's work out part of it.
Well, I appreciate you joining us today to discuss your approach and this innovation in terms of the software that you're using. And we hope to have you on future episodes.
Sounds great, Mark. Thanks a lot.